boring year after the last couple is pretty much another banner year for overall market volatility. And this weekend, we saw Celsius, one of the crypto lenders, halt withdrawals, which created a panic in crypto. And I think nowadays what happens is crypto is really just a risk asset, and it's between the futures and everything else, it's just innately linked to overall risk assets like the S&P and the Nasdaq. And so I think when you get an implosion in crypto world, it kind of just shifts over and implodes tech and then brings down just all assets globally, which is kind of incredible.
So everything's just correlated now.
Yeah, it's and I think a lot of that probably has to do with just the scale of investments in crypto, and then I'm sure linking up the futures. I know there's a lot of people out there probably arbing some of that stuff.
So what was today like for you? I mean, just for a little bit of context for the people listening, Nasdaq's down 4% or something like that today. I mean, was this a busy day for you? Did you have a lot going on?
Yep. So it had the potential to be a busy day where I pretty much cleared my schedule. I pretty much cleared my schedule and wanted to make sure that if something crazy was happening, I would be able. And despite the huge move overall, we really never got that flush where volumes weren't really that elevated. And a lot of the characteristics that I need to see that capitulation were not happening. And that always takes people by surprise because they think, just simply based on price, I would be involved. But really, none of my decisions are price-based decisions. It all needs to be in conjunction with price over time and volume capitulation. So if the move is what I call like a slope of -1, where you're just steadily decreasing, I will have zero shares and not want to fight that trend, which is largely what happened today.
So you're saying you don't want to fight the trend, but is there anything in you that kind of wanted to go with the trend? Like I know that everyone kind of knows after our last interview, you gravitate towards these capitulation trades, but I know your playbook's a bit broader than that. Is there anything in it that sort of gets you into trades on the sidelines today?
Oh, sure. So, I mean, that's a great question. And so despite being now known as a capitulation trader and that being one of my specialties, I very much will always try to go with the trend when I can. But the key there is I still need a proper setup. And so in this specific instance, first of all, like big picture, we're just way too overextended over the last couple of days. So nothing, like I think you would have to be insane to start thinking short today just because of how extended we are over the last couple of days. That being said, if something consolidates at a level and then breaks down from that level, I will absolutely consider going with that trend and vice versa to the upside. So it's not that I just do capitulations, but it's more so capitulations allow you to be reactive and are highly probable and profitable in some of those situations. But I would say I've done a great deal of trading with that trend as well. But I really need that set up, and in this case, yeah, just too extended from anywhere I'd want to be. Because one big trend overall is in my trading is I need everything to align. I need it to be a buy on the intraday. I need it to be a buy on the daily. I want everybody on every time frame screaming buy. And so right now, as far as a short with the trend, you have too many people thinking long because it's just too big of a move. So that helps me avoid a lot of the wishy-washy, choppy stuff and helps me get my win rate up.
Yeah, that I think was a really valuable answer, talking about sort of the larger context. We've been down for the past few days now. To be looking at entering new shorts sort of becomes a lower probability trade, right?
Exactly. And what so many people miss just as I've been more in touch with the Twitter crowd and everything else, skin a cat. And there's not necessarily any right, any wrong. People can do many things different from me. But the biggest thing is that when everything just goes through the roof. And so a lot of people that are struggling with consistency, it's because they're not really getting enough people on their side as far as like I see it's because they're not really getting enough people on their side as far as like I want the hedge funds I want the hedge funds to be buying. I want Warren Buffett to be buying. Good old Warren. Thank God, a couple of years later through COVID, he's thank God, a couple of years later through COVID, he's still kicking, and I can make an example out of him every time. And I want Warren Buffett to be buying. I want the hedge funds to be buying. And right now with that short, there's too many people like myself thinking buy. In fact, like to be this overextended, it's funny. I reached out to Twitter today, and short, there's too many people like myself thinking buy. In fact, like to be this overextended, it's funny. And ask, can anyone crunch the stats? And there are only 30 other times in history when we've done a 10% move in 3 days. So it's a pretty incredible move. And then statistically, the Twitter user that responded to me, he even the numbers and found that there's actually positive edge in across those data points, that the market tends to bounce from there. So to start thinking short now, that's why you end up with poor results for people that do that. It's because you're just chasing, and the odds aren't skewed anymore. It's so against you at this point. You know, that the pendulum swung too far to now think that way.
Yeah. I think that's a hugely valuable answer. Anyway, Lance, last time we did the podcast, what was it like when we actually recorded it? I know it only got released a few months ago, but
right, it's been, and I can't believe just how popular those episodes were. And thank you for we brought a lot of knowledge to the people, and so I would have never imagined what was going to come right after we were.
Yeah.
And so as you've mentioned and appended onto that podcast, so the market went nuts, and I was really hitting my stride of my career where I was zoned in. I had all my reps, I had all my experience, and I was in just the perfect position to capitalize on that. And it was one of those things where if on a normal slow month, and nowadays people forget just how slow the market can normally be, but on a normal month, you might get just like a couple big plays. And maybe you get a couple pocket pairs, and you really just try to do whatever you can with 10 jack most weeks. And 2020 and 2021 were pretty much just nonstop pocket pairs every single day. And so that market was a learning opportunity for so many people, because you're getting probably 10x, 20x, 30x the reps. And then if you're experienced, you're just able to play the best hands. You know, it's like sitting down at a poker table and all you get is just fire hands. And so when that happens, what was so great is myself and other top traders around me, we just knew like this is it, guys. Like this is the Super Bowl for us. And everything else became second priority. It was time to perform. It was time to take full advantage of it. And every single day, you wanted to go in there fully focused and maximize the size and really, as they say, make hay while the sun is shining. And so pretty much I ended up doing that and just put up some banner years for the firm. Was top trader in 2020 and 21. And a lot of people on Twitter have asked, like, what do some of those opportunities look like? And man, I would just say they ranged the full gamut. It's obviously there were a lot of capitulations. AMC and GME were some incredible tickers. But the thing to keep in mind is pretty much every single day you have stocks just going so far in every direction. I mean, I remember especially in March, you had ETFs that were just trading at massive discounts to their net asset value, stuff that should never, ever happen, you know, because again, we're not talking closed-end funds. We're talking fully arbitrageable just ETFs. Like I remember there was this crazy blowout in GDX and GDXJ where they were just some of the most liquid ETFs and largest ETFs in the world, but they were just trading at just egregious discounts due to forced liquidation. I mean, just a once in a lifetime opportunity in the career of a day trader to capitalize on it.
Okay. Hopefully it wasn't a true once in a lifetime opportunity, and there will be other instances like that to come. What you just said there at the end certainly piqued my interest. Can you talk more about that particular trade? ETFs trading, what was it, way below their net asset value. How do you arbitrage something like that?
Yeah. So what happened essentially is it was such a panic and such a liquidity crunch, and some people wanted out these things regardless of price. Some people were, of course, margin calls and everything else. And so what we saw all across obviously as an ETF, you have your net asset value, which is the value of the components based on their weightings. And so realistically, you should never sell below that or above that just because you can arb it out against the underlying components. But what happened was the markets were just so broken and just so disconnected that GDX and GDXJ were trading at like 10% discounts and stuff. And this wasn't for just small size. This was like all you can eat. You probably could have parked 50 million, 100 million, hundreds of millions of dollars, probably even billions of dollars across all the ETFs that were dislocated. And then theoretically, you can short the underlying components, right? So if GDX is made out of, call it 5 tickers, just for example's sake, you could buy the underlying, you could buy the ETF, which is at the discount, then short the underlying holdings, and theoretically that spread will converge when the market gains rationality. But I think people were just at a shortage of capital. And so here's the other thing is ultimately to do those types of trades also takes a massive amount of buying power. So whereas some people might arbitrage that, I largely would do something like that just purely naked. And so the funny part too is you almost don't even want to hedge out the other side of it because even the components are just getting clobbered so much. Where it's like, if even the components are panicking, yes, the ETF might be at a discount. And part of the funny part of this too, and the craziness is gold is generally a safe haven asset. And nobody cared about price. It was just get me the hell out. And once that panic kind of abated, those GDX and GDXJ just went off to the races to the upside.
So you said your trade, you weren't arbitraging it. You were naked on one side. Which side was that? Were you short the underlying?
Just long the ETF.
Long the ETF. Okay.
The funny part too is when I went long the ETF, the next day I think it was over a weekend even, and you're just like, well, this is pretty much free money. And sure enough, like the next day the market was down and the spread got blown out even more. Whereas it really was one of those periods where I think it was John Maynard Keynes who said the market can stay rational longer than you can stay irrational longer than you can stay solvent. And this was one of those things where for many market participants, you could think you're a genius buying GDX at a 3-4% discount, but that doesn't mean it won't go to 10%, 15%, and so on. So you really got to be smart about your exposures and everything else in those times, because realistically anything can happen in the short term.
Well, exactly. So that just makes me wonder, like, why you didn't want to treat it as an arbitrage type of trade.
It's largely just due to the BP intensity, the buying power intensity. But I would also argue that you run the risk of where you couldn't be so confident that other stuff wouldn't get blown out either. So you're also opening up to the risk that spread will just open up more. So maybe GDX and the ETFs will go lower. Where like it's only all risk-free if you can theoretically just hold. And that being a day trader, that really wasn't something I wanted to be tying up my buying power. And so I was more so trying to kind of pick my spot when it reached just peak insanity and get some immediate relief on that.
Gotcha. Okay.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tools to trade your way. Options, futures, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital, with IPOs, and short anything you like, with zero locate or hard to borrow fees? Start your evaluation, get funded with up to $200,000 in buying power, and build confidence risk-free. Before you Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Lance, since you've come online, you've been sharing a few ideas and a few concepts. I think it would be a really good idea if we can kind of flesh out some of those. And one of those being the broken slot machine concept, which I think largely plays into stock selection. And I think also ties into kind of what you were talking about earlier, picking those really good couple years. So can you speak to the broken machine concept?
Yeah, one of my favorite blackjack. There's infinity games that, but now what happens if probably each day there's maybe only 5 to 10 of those that offer really significant edge. And what I would find though is people would just be so ingrained in their habits, or just people would label and identify themselves as X kind of trader. And I thought labeling yourself as a type of trader is asinine, right? Like, I don't want to be the capitulation trader if IPOs are like printing money. I don't want to be labeled as the capitulation trader if breakouts and low floats are doing a lot of money. So I really want to move to wherever the most edge is. And so that's my analogy, is you need to find because of earnings, or it could be because of a technical pattern, or it could be because of panic, and it could be a capitulation. But like, the more I meet with traders, or like help people out over the internet, or in some of the mentorship I do, you find that people don't do a good enough job of just finding that play that offers edge. And if guess what? You can be the best roulette player on earth. You can be the best blackjack player on earth, or the best slot machine player on earth. And guess what? You're not making money. That will never, ever help you compared to finding the stock or the machine with just drastically incredible odds. In fact, often if you're in the right stock, you can even trade poorly and still do well. First, make sure they're playing something that isn't just noise, because there's so much of it in the stock market.
In one of your reports or sort of reviews on one of your trading days, I think you used the word magnify, like it magnifies your edge, which I thought was really such a great word to use. What is your morning process each day for finding the broken slot machine?
Yeah. And so even to touch on that real quick, I think one of the places, and that day is the perfect example of this concept. If you were trading a random stock, of course you're going to have negative expected value. And to do better than a random stock, maybe you might trade the Qs or Tesla that day, or Apple, because they were a little bit more in play, a little bit more volatile. And so that's one step closer. But it just so happens that my tickers, when they bounced, the market and the Qs and Apple and Tesla, all of those rolled over to lows. My 3 tickers did not. And I would argue that that is exactly what I mean, where when you're in the right game, it magnifies your edge and gives you that cushion. If I had just simply chosen a less extreme and a less good slot machine, I would have been stopped out and taken a nice size loss rather than having a massive gain. And so by being at the right game and that write-up, that changed the whole trade for me. And that stresses the importance, right? Because you can do everything right, but if you're in the wrong game, you're still going to lose. And it's such a big deal. And so you asked about my morning routine to spot some of these things and identify these things. So first of all, a lot does come down to that prep, especially in this type of situation. So even beforehand, I was studying these tickers. And in that write-up, I mentioned probably a lot of people weren't doing the legwork like I was doing. With MSTR, which holds Bitcoin, essentially, I mean, it's really kind of a software company, but it largely holds Bitcoin as part of its assets and moves with the price of Bitcoin. I highlighted in my write-up that MSTR, despite largely being a Bitcoin tracker, was down 2x the move as the price of Bitcoin. So if you want to talk about a cushion, I could very well potentially have bought MSTR, and there was so much cushion where in the long run, potentially, if Bitcoin went another 25% lower, I might still have broken even. Win another 25% lower, I might still have broken even. And if Bitcoin bounced, then the upside would have just been incredible. So part of that morning prep was I was studying these. I was looking at the charts. I was analyzing the daily charts. I was analyzing the volume turnover as the percentage of the float. I was thinking about the risks involved. I was thinking about what prices I would want the most. So a lot of it does come down to that morning routine. And a lot of it is also being aware of just what's in play and what's working. If the market's melting and you're, thinking, ooh, like my slot machine is going to be breakouts, you're probably playing the wrong game. That being said, there are times when IPOs all just have incredible follow through, or there's times when IPOs all just melt and they can be great shorts. So a lot of that is being aware of what's working in the market, what's offering the most edge, and really taking the time to make sure you're in the right stocks. Because if you're not, then
example traded during a that you wrote about in that report. Do you have another example? I'm just, because I know this is such an important concept to you. I'm just thinking if we can sort of really drive it home. Is there another example you can think of, where you did a good job of identifying, as you call it, the broken slot machine for the day?
There's a big difference between playing a stock that isn't that moving that much, or I think back in February there was a time where I played Tesla. And the market was down a couple percent, but Tesla, for whatever reason, was down like 50, 60 points. I think it was gapping down to like 690. And this was the case where it seemed to be down so much more than the market and making such a large move, despite Tesla actually being generally a very, very great bouncer. And this was the case where we then also had a sell imbalance. And I was thinking in my head, oh man, I wonder if this is just somebody that's really panicking out of this thing. I ended up buying and taking the other side of that imbalance. And sure enough, the second that imbalance and the market opened and everything crossed, Tesla just took off like a rocket. And what I essentially was doing was I was buying a ticker that was so much more overextended than the market. Oh, you want to know actually what? And so oil prices were spiking that, the market down. And so you also have the added layer of irony that, like, wait a second, if oil prices are going to the moon and we're going to have this war and gas prices are up, if anything, you can make the argument that stimulates more electric vehicle demand. So from many layers, you start to build all this cushion and this logic behind buying Tesla rather than buying the NASDAQ. And when you end up doing this properly, it doesn't just magnify your reward, but it also reduces your risk. Because further, and so often, your ticker will end up staying flat, or at least greatly relatively perform. And so really, it's not just a matter of higher reward, it's also lower risk and even better probability of outcomes, which is so important.
Okay. I just want to make sure that I sort of understand what you're saying there. It's interesting because, when the whole war in Ukraine initially kicked off, like everything was down though, wasn't it? Like the whole market was down. So is that, probably plays into part of the reason why Tesla was down, right?
Yeah.
So why were you like looking to buy?
Yeah. I was able to even just, while we were talking, look up the date. I think we're talking February 24th for just more clarity when people listen to this. So much of what I do is, again, it's not just about price. It's about price over time. And so if people end up pulling this Tesla chart, something like 5 days prior or so on February 17th, Tesla was at around 920. In a matter of 5 trading days, we're now gapping down sub 700 in a straight line, all down days. And so it's not that 700 is some magic price, but it's just that we went there so far, so quick, right? Did the long-term expectations for Tesla probably really is just because it was so far, so quick. And so even as we record today in a period of market environment, and for the viewers and listeners, this is June 13th, after, like you said, the market was down 4+% or so. And so the reason why today, or these days, I even have a long bias, it's not because the market was down so much, but it's more so because the market and the Nasdaq was down over 10% in 3 days. Like those are just stunning moves when what really changed in the world so quickly. Like it's price over time is the magic that everything needs, not just price.
Okay. Very good. Let's keep moving now onto another concept. And again, this is one which you've shared online, but I think it would be good if we could flesh it out a bit more. And this is probably just going to further increase is the capitulation trader, but
or at least a relatively good one.
Okay.
So the right side of the V was a post I did, and the point I was making, which is often a little bit misinterpreted, was simply this: you can buy in 2 different times the same price, and times the same price, and in those different times they will have drastically different. So first of all, you now have a stop in that you can use at lows as opposed to no stop when you're buying on the way down. And the second thing is, not only do you have a stop, but your probability of success is higher because now you're going with the trend rather than fighting with the trend or fighting the trend. And so many people often miss the point. They say like, oh, like in your chart you drew, like you only know that it went up after with the benefit of hindsight. But those people aren't understanding that like it doesn't matter what happens after. Like understanding that like it doesn't matter what happens after. Like regardless of the outcome, in that moment in time, you still have a stop. And you're now going with the trend on the way up rather the way down. And you're now going with the trend on the way up rather the way down. And there's many ways without hindsight that you can define being with the trend, right? Like maybe you broke a downtrend. Maybe you're making higher highs and higher lows. Maybe price is just simply going up rather than down. So it's very much not hindsight biased. And number 2, the other thing that I think people fail to realize is it's not just about waiting for the turn. This concept applies to so many different situations. So the example, it's not just about waiting for the turn. This concept applies to so many different situations. So the example that I like to give is also in breakouts or in breaking news. And if you have some stock that's setting up with a really, really nice level, some nice resistance, maybe at $10, I want to buy 1001. I want to buy right when it breaks if it's a really, really good setup. And in the best setups, in my opinion, that stock will just be gone. Everybody else will scramble. In my opinion, that stock will just be gone. Everybody else will scramble to buy. It takes off, pushes away from the level, and you're in the money, and it's never looking back. And if, though, I should only buy the ones that come back and I buy 10 after it fails to go, or if it's just putzing around somewhere, I might be buying 1001 and it's the same price, but my probability outcome and like the reward and everything is just so much different than when I bought it initially. And an even more extreme example of that is in breaking news. If I were to tell you, all of a sudden the Fed isn't going to raise interest rates, when you first buy the market, if I can buy from flat those prints, I have amazing expected value on that. But now if over the course of 10 minutes or 30 minutes or an hour, that price makes its way back, that's not the same expected value as when that news first hit, because now people have digested everything. And for some reason, we're still coming back. And that's just a totally different situation. In fact, now you would need to worry like, oh man, what am I missing that price is coming back? So it's not that it's hindsight or anything else. It's just simply saying that the expected value is different despite situations where the price can be the same. And that's so important to recognize because people often don't realize how much their probabilities are changing of success.
So I noticed you use the term expected value quite a lot. I think it might just be helpful for anyone listening who perhaps doesn't quite have their head around exactly what you're referring to there. So, I mean, what does it mean for you to kind of think in terms of expected value on a trade?
Yeah. So expected value math really is the basis of everything in trading. Whether people recognize it or not, or whether they're familiar or not, it is the fundamental driven thing, and essentially what is a betting game, the same as it is in poker or anything else. And in fact, when I was doing some menus in just 2 sentences, are you able to accurately assess the expected value of a trader opportunity? And then are you placing your bet size accordingly? And I think that is literally everything this job comes down to. And so expected value is, what are you going to make when you win times the probability of winning. Then you subtract out what you're going to lose and the probability of loss when you lose. So that applies to anything from coin flips to rolling of dice to poker to blackjack to everything. And what you realize, though, in a game like poker, where the universe of opportunities is pretty clear because everybody knows the different hand combinations, when you have pocket aces, for example, you know that your probability of winning is way higher. And as a result, your expected value of that hand, essentially, if you were to play that hand 1,000 times, what are you generally going to win? And when it's way, way better, you need to make your bet size reflect that and bet drastically more. And so expected value and your ability to accurately assess it really comes down to every single thing you do in this job. Every single trade you put on, every single sizing decision, it all comes down to, are you doing that according to the actual true expected value? But with trading, it's quite hard, right? Because harder. There's times where you might buy a breakout and you don't know what the reward is. So unless you have a target, filling out what that reward is can be quite hard. We might just need to estimate. If anything, the easiest one generally to handicap is simply your risk. You know what you're going to lose if you're wrong because you just know what your stop is generally. But the other part that makes it extremely hard is there's a very wide probability spectrum. Unlike in poker or in flipping a coin or some of the other, my rough assumption is we might go a symmetric 2 points. I think there's a 30-40% chance of that. I know my stop is just going to be right below this level. So the best we can do, you never even know what the expected value of a play was. You're always left guessing and refining, even while markets change. So that's what keeps...
Example of right side of the V trade. I'm just trying to, MSTR, I know that's a trade you wrote about in your report, sort of dropped from $300 to I think about $150. Is that right? In 4 days? Seems like a huge drop.
Oh, indeed it was. Exactly.
Right side of the V, right?
Yeah, absolutely. And what happens with this is, and again, my way of defining a change in trend isn't necessarily what's going to be right for anyone else. There's many ways to skin a cat. Everyone will think I have the smartest, we can all be right. And so for me with MSTR, this stock was clearly melting, just quite a large amount, as you said. And there's many different ways to define it. It could also be a trend line, and you really don't know how it's going to pan out until you actually, see it in real time. The market was, essentially everything was going lower off the open and bounce. And so maybe, I can't tell just from this picture, but maybe you did break prior bar highs, maybe you don't. But really what did it for me was at around 845 or so, a lot of stocks, markets, that's just essentially a volatility halt where there's just so much excess demand and the stocks moved up so quick. So far, was selling off very, very, very aggressively, while everything else that wasn't move like it was. So then once Carvana and I think Beyond and some of the others went to the limit up, MSTR then broke highs, and that now was essentially the right side of the V. And so to the critics that say, oh, it's all high, getting along above those prior bar highs, anything can still and now the trend is going higher. And so that is essentially waiting for the turn, right? Because otherwise I could have been buying 150 off the open, 145 off the open, 142. So it's not really just one price down.
I'm buying capitulations. I mean, for me at least, initially it kind of sounds like you're trying to pick the bottom, you're trying to buy the bottom and, time it. But, this concept, the right side of the V, it's almost like helps to reduce the risk of being too early, right? It sort of moves the objective of the trade from trying to, pick a bottom to actually, trying to identify.
These things are theoretical. And what I would find is before I waited for the turn, is so often buying on the way down, one of two things would happen. First of all, if I had a stop, I would end up taking happens. If I try to avoid death by 1,000 paper cuts by just being loose and not having a stop, then you end up where things go much further than you ever would have imagined, and you end up drawing down and also putting your before the turn. And what it really does is it forces you to be patient and wait for that turn beforehand. And that turn, yeah, you get like a little bit worse price. And what I found though is your probability of being correct and the just escalated my trading results. And the other thing that people will say is like, oh, but what if you can't get the same amount of liquidity on the way up? Keep in mind, this only really applies to intraday trading world, because most higher time frames, you're going to have all the liquidity you generally need anyways. But so on intraday trading world, it is a valid criticism that you might not be able to get as well. First of all, you can get all the stock you might want or need. And even if there's some situations where you can't get as much because we're turning and everyone's trying to buy, on a risk-adjusted basis, I was still just so much better off. So I ended up because you're taking less risk and you're more precise with your entries, like you can actually take more risk when the liquidity's there. So this really catapulted my trading higher. Like it's not even 2021. Like you're just in such a better position to swing huge in, death by paper cuts. The other thing too is it's just less things go really, really crazy. So yeah, big points are it's not hindsight. Of course, anything can happen once you buy, right? I'm not saying it has to go up. I'm just saying you now have a stop and your probabilities are better. And then number two, it's not just in these situations, but in many situations.
The concept you have, Lance, is sort of channel fundamental. But can you just speak to holding through, let's say you buy a breakout or you buy a turning and a larger move that could potentially, how do you avoid getting shaken out? How do you manage holding through the?
Yeah. So what the channel fundamentals concept says is it's so important, not to normal psychology. So what happens is you get all this buying that then exhausts itself, and it's normal to have a healthy pullback. And so all the people that chase, they end up getting scared. They start to doubt themselves. They don't like not being in the money immediately. And so they have the which is just healthy and a common pattern to unfold. I want to be buying, which is just healthy and a common pattern to unfold. I want to be buying or adding there. And again, this makes no prediction to say that this trend won't break the actual lows rather than selling where the higher lows. And nobody's to say how that pattern's going to unfold, right? Like I might be buying what I think are the higher lows and it might just go right to lows and stop me out. That's fine. All I'm saying, point before the true stop. And so often in these trends, you see that recognize this pattern and can take advantage of that recognize this pattern and can take advantage of this behavioral bias by all.
Sizing is a topic which you have a few things to share. We're going to be doing part 3 here that came through. Someone said, Lance mentioned betting 20R on a single trade. What's the thought process in risking such great size for one trade? Now, I'm not sure if that, I presume that I mean, is that something you said?
It's true that, and this is something I work with so much with, and this is something I work with so much with the traders I mentor, enormous skew in their trading. And so when the opportunity set gets drastically skewed in their favor, when they get those pocket aces, they are not betting linearly. And so what I mean by that, right, is if you have if you have 2-7 or maybe 5-10 or 7-10, and you bet $1, you bet $3, you will not be a profitable poker. You bet $3, you will not be a profitable poker player. Why is that? They're aces. And so what the really, really great traders recognize is on those specific it outweighs all the variance of everything else. And the way to do that is to bet exponentially. And so here's the thing. I recognize that there's a lot of people that might just be the consistent single hit. Doing so is not optimal, and it's not going to be maximizing your P&L. So everybody has their own personal risk tolerances, and you really should, if you want to optimize it, you really do need to define what are their best setups. Most people can't categorize all your aces are in and what the examples are. Need to rep those again and again so that you recognize in real time exactly when the play is so good, and then you need to figure out how much you want. You recognize in real time exactly when the play is so good, and then you need to figure out how much you want. At some point is A is $3,000. For me, a C, because I tend to be fairly selective, I might just not trade a C trade at all. But then a B might be 5 to 10, A minus, A, whatever. And then I can make sure that I'm risking kind of what I pre-set out to do so. Because in the heat of the moment, and minimize your decisions. So if I can simply look down at a note card and know, like, okay, Lance, like, you think this is an A, you think it's an A for these qualities, you better be risking this amount. And all it does is help you be more conscious in their trading. And when you do this effectively, what can become is, because once I started to know what I was good at and recognize these opportunities, I was just betting so much on these, and it's just rocket fire when you're betting on the right places.
Like, this is probably one of the things I need to try and put into practice a bit more. This all sounds really great to hear about it. Even though this might be a really great setup for you, it might be A++ or whatever you want to call it, doesn't necessarily mean it's going to be a winning trade.
Yeah, and so this is such an important question, and I know. So I have a performance psychologist who really the one, and this is a topic to go all the way with it. You need to actually commit and stick with it. And you swim halfway across the pool and you say, oh my God, like, this is so scary. I don't think I can do it. Like, oh no, this is awful. Benefit. And you never actually made it across the pool, even though, like, you just needed a little faith. At the first loss, they say, holy crap, this wasn't for me. And then 2, expect that you're going to have doubt. And it's all part of it, right? Like, this is something where if you don't leave your comfort zone, you're never going to be able to grow. And people might even, like, just overreach a little bit, and view it is that is the cost of growth. That discomfort, that doubt, that is exactly losing the system and the data to back it up. It's one of those things where when you get halfway across the pool, you need to say to yourself, like, look, this is supposed to be scary, but I've thought about this. I've game planned this. I'm doing this intelligently. I know that I think would help a lot of people, because what you asked is so common. And I can even think of one specific person I mentor that experienced exactly that. And ultimately, he just had to have this conversation with himself. And Jonathan Katz was guiding him through it, and he recognized, like, losses, but I've been taking losses for the right reasons and to pursue this next step. And that discomfort is what I need to be there. And I will keep on swimming to the other side now.
Clearly lay out what is their kind of, what's an example of an exponential bet?
Roughly how much you are risking in your C trades. And this will transform the average novice's trading. Whatever you're risking on a C trade, transform that and make that zero. Just stop. And again, it's all subjective. People are going to say, "Oh, my C might be your B." Like, I get all that, but just go with the concept for me. You always all that risk. Just save that risk for your A's. And so now on your little risk scorecard, your little note card, whatever, just do some kind of bump on the A's. And look, if you're really experienced, you can allow it to be very exponential. We don't need perfection. We don't need massive leaps. Just each day, move a little bit closer to this exponentializing, and then the more experience you get, exaggerate it. And this one little task or this one little kind of...
I know speak about or accelerating the learning curve. Obviously, everything we've just discussed could be sort of packed into this. Well, is kind of optimizing your time. So optimizing your study time, for example. So, in the case where, let's say someone, an be suited to use that time, most effective use of those 10 hours per week.
And a lot of positive feedback I got was on, I believe the other one was also talented is over. A lot of the meta learning focuses on how do you then get the reps and the experience, mindful, conscious experience, real world lifelike scenario experience that you can then get reps on, reflect on, and improve. And so even if you read, I think it was Tiger Woods would never ever hit a ball at the range or anywhere and then not reflect on the shot. Honestly, hit, and get nothing done. It wouldn't accomplish anything. And he would say about concepts applied to trading. And so one of the most important questions is, what is the most effective use of your time? And really, slot machine, when really all you want to drill down on are what are the and I used to say this all the time in my office, stop focusing on 2-7. Some amazing trade would happen, and then maybe 3 hours later, there's something in a different ticker, some small little thing, my trading screens throughout the week. And every time there was a really big play, trimming that video and building, I would just be repping that again and again and again. I guess if the fourth practice would be to get some type of feedback from, and all of these practices, I think, are probably some of the most scientifically backed ways to get better, because essentially you're studying, trying to improve on the most important thing each day through the daily report card. And then you're constantly getting feedback, both from the market in the form of P&L, and I know retail traders say I don't work for a firm. I don't have that type of mentorship, that type of environment. Well, can't trading online trading groups or just finding a mentor. Again, how do you find a mentor to help refine you and hone where that time should be? I think that's really just a recipe for success in a very
came through online. You're a big advocate of, and this is something you spoke about on the last podcast we did together, is those 1% daily improvements. Are there any other concepts?
Yeah, so that is a great question. And that book is the Bible for me. So it's not just the 1% improvement. One thing that's so important is just that essentially your performance is a lagging indicator of of your habits. And so what I see all the time is people will start to do well, and they stop doing their DRC, they stop putting the time in, they start going out during the week and going to work hungover, they don't get good sleep, away with it for a little bit. And so when you stop doing those, you think, oh, I'm fine. And maybe a week, a month, couple months goes by. And then not too long after, all the things that helped you come to me and say, oh, I can't figure it out. Why am I doing this? And I say, are you doing X, Y, and Z? And they say, oh, I kind of stopped that once I was doing it. The other side of that is I have that conversation with them. And then a couple days go by, a week goes by, and they say, Lance, like, I started doing a DRC. I started, it takes time. There's a lag. So that concept is so important. I think what he talks about regarding identity is no matter what, I take my stop. That's a very powerful thing to have, because what happens is in those questionable moments where you might otherwise, it's not, this even came before Atomic Habits. It's just like I discussed the amount, which all my friends can attest to. But when it comes to dessert, I don't like these things, right? Like if you give me apple pie, chip cookies, like it, but it's so ingrained in me that like it's just, and so I might have it maybe a couple times a year. Really powers me through. Same with the idea that does not miss a workout, right? And so what that allows me to do is, even if I'm traveling for work or even if I'm busy in my life, it's one of those things where, because that's what I tell myself, I reprioritize my values, and that makes a difference. Say, look, guys, I walk everywhere. I take the stairs, and even it's almost like a fake it till you make it. But really take an Uber or drive, I will really try to walk. And this stuff adds up. Environment being more important than willpower is huge. And all the time, if people miss their stops or they take shitty trades, they say, oh, I need it really. And so in terms of trading, the question is, how can you avoid that situation? Maybe that means having a lockout on certain segments so you don't snowball. Maybe that means cutting yourself off from that. And I think really all those topics are like priceless things to be reflecting on. I really could go on applies to trading or life.
Yeah, well, I know we said at the beginning of this that we'll try and keep it to about an question, and then we'll wrap things up here. But and I'm not even sure the best way. Something I hear all the time is traders going, oh, I should have done this. Oh, I should have done, I shouldn't have been so quick to cut this trade off. And, I try and catch myself each time you read into that. Obviously, I'm sure you've heard it as well. I don't think anyone says, the phrase, I should have more than traders. I just kind of think, to use that phrase much,
Yep. And that's a great point. It comes up in Thinking and Bets, that one book. And it's so...
I know a little bit of it's like obviously hindsight, but...
Yeah, well, so that's the $1 million question, really. It's like, are you saying that because there's an actual change you should be making to your system? Or are you simply saying that because the price action dictated otherwise? So let's say that, and the best way to do this is you need to have some type of reasoning and rationale, and ideally it's documented so that you're not just flying by the seat of your pants. And so, for example, with my system, so often my stop is going to be prior bar lows or prior bar moving in my favor, and that's a pretty common stop for me. So if I got stopped out, I should have held. The question is why? Why are you saying that? Does your system truly dictate that you should have done that, or are you just using hindsight? And if I took my stop like I should have, and I have no otherwise rationale other than the outcome, you're just being dead wrong. And it's just so toxic to think that way, right? Because I can take a massive loss and the stock can immediately just do what I originally thought. But that, because it's all about what occurs in the aggregate. And on average, you need to optimize for that. You can't just cherry pick the situation. Is there something different and some tweak I should make to my system that will be more effective in the aggregate? If not for that, like it's just such damaging just language and mindset, right? Because
was great.
Analogy, like playing roulette and it lands on your number.
Yeah.
But it's like, no, it's a
Yeah.
but it's like, no, it's a negative expected value game. Like you're only saying that because you won. And so it's just yeah.
To that question.
Just yeah.
To that question. All right, Lance. Well, I think this has been a phenomenal episode. To find out more about yourself and follow along with what you're doing. Where is the best place? Find out more about yourself and follow along with what you're doing. Where is the best place to go?
I promise you, with the Aussie accent, you can do no wrong, and the Twitter world will love the ONE accent. You can do no wrong, and the Twitter world will love the ONE LANCEB. And yeah, that's probably the best spot. I would like to very quickly, touch on the Impact Competition, which is my little nonprofit. We help turn these competitions to their school and make a bigger impact in the world. ImpactCompetition.org is the spot to go. Otherwise, see me on Twitter, tweeting my butt off with a lot of
236. This will be episode 236. All right, Lance, we'll enjoy your evening and we will chat again. Lance, we'll enjoy your evening and we will chat again.
Zero Hype on the way soon. So to stay updated with each great traders soon. So to stay updated with each great traders.
Trade the pool. Did you know that every decade the market reinvests? Online brokers opened the doors. Mobile apps made trading and commission-free trading erased barriers. Now a new era has begun. Meet Trade the Pool, limited risk. Trade the Pool funds home up to $2 in buying power. That you can trade larger positions and scale your strategies without savings. It's time to trade with more capital. Really worth your time and effort. Ready to trade the pool? And join the stock trading revolution today.
Indicators, know your profit odds, and move fast. Trade options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tasty.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
Here on episode 237. Today I'm speaking, better yet, an author. Mary is the author of The Bond King, a biography about industry titan Bill was once the biggest bond trader in the world. And about his story, and I'm sure that's probably the case for many others too, which is the reason why I was keen to get Mary on the podcast. He spent countless hours researching and conducting interviews to produce her book. During this episode, we go through the life and times of Bill, and Mary highlights some of the standout trades that put PIMCO on the map, including a trade during the 2008 financial crisis. Last thing, if you would like to get your hands on Mary's book and read about the events we discuss here in much greater detail, go to chat with my guest, Mary Childs. I have such a great admiration for writers like yourself who go to the effort. It's be a relief to have got it done.
Yes, it was an extreme amount of work, and it is a huge relief. It's funny because I get feedback from friends who are reading it, and they're like, "Holy smokes, this must have been a lot of research. Like it reads like it was a lot of research." And I'm like, "Is that
Point right at the end, you said something about, it was take dollars not to publish it. What a shame. What a shame.
I know, right? And real missed opportunity there."
Right. And so you talked to, I believe, over 200 people, well over 200 people. Did that include the man Bill himself?
It did. So typically I can't comment on who is among those who did speak to me on the record. You can kind of tell in the manuscript because, and I think this is consistent throughout. If it's not, then that's just like a copy editing error on my part.
No, I interviewed the author who did the book on Jim Simons.
Great, yeah.
And the
Yeah,
one
love
on,
Greg.
Nav, the flash crash trader. And
That's always a bit of a luck of the draw, but he has been in the media for so long and talking so much about how he thinks and what he does and kind of thinking in a really interesting and open way about his life. Material to work with, even if he didn't talk to me.
This is something which kind of surprised me from the book and something I was completely unaware of. Do you know any other traders who have a motivation to be famous?
Yeah, I mean, Jeffrey Gundlach has a bit of a similar, or at least like parallel in its way, story where he was watching Lifestyles of the Rich and Famous while like eating, takeout or something, eating his meal on like some cardboard boxes in his apartment. And he was like, wait, what am I doing? What can I do that will get me this rich? And I mean, it's not the same because I think, but yeah, Bill's pretty special. I don't think there are that, if you want to be
go to Hollywood or something like that.
Yeah, just straight to TikTok. Yeah.
Yeah, of course. The modern day Hollywood.
Exactly.
So tell me, why do the people need a book on Bill Gross?
For that to happen, but it does sort of underscore the relevance of this book. Reflective and just kind of a labyrinth of, I don't know, to create the modern bond market. And it's remarkable that a lot of these kind of living legends are just like milling about in our world and we can just like go ask questions. That was one thing that was kind of legends and people who were like way back, that the names that we don't know today, that his history tells the history of the bond market, of basically, I would say, modern American finance. So to me, it's like, okay, you can get on this like spectacular that everyone comes out completely fluent and is like no longer going to invest with BlackRock and they're going to day trade with all get a human story like this, an interesting, compelling story like this, but also get that kind of didactic element as well. It's usually one or the other, I feel like.
Yeah, bonds are kind of, they're harder to access. They're sort of a bit more behind the scenes, right?
Totally.
It's very much an institutional kind of game. But one of the things you actually highlight at the start of the book is that the bond market is actually much bigger than the stock market. But it's kind of weird because less people know about it or, understand it.
We just don't talk about it in the same way. Yeah, exactly.
So what is the bond market and, what type of bonds was Bill and PIMCO involved in trading?
Yeah. From investors, usually institutional investors like PIMCO, BlackRock, and, agree on a term and a price, a yield will be over that term. And that's kind of mortgage market for big kids. About it so much less. It's just like so removed in a way from our daily lives. And if I wanted to play in that market, I kind of just couldn't. But I think, it is more influential in my view. This is where, you can end up kind of handing the keys of the company over because the distressed investors that came in and like reshuffled things are suddenly running the company now. Or this is where, you hear about James Carville in the Clinton administration talking about how when he comes back, after he dies, he wants to be the bond market because nobody's scared of anything like they're scared of the bond market. And like that's real. This idea of the bond vigilante has changed a lot over the years, and I think it kind of lost some of its potency in the US, but this is a real, there's a lot of actual power in being a lender. And you saw this expressed really acutely in the American financial crisis, in the interaction between the US government and the institutions like PIMCO and BlackRock. And these society kind of has to make its kind of agreement between the government and the private industry. And I think that is so poorly understood in our society. I think there's a professional moating that happens where there's like, oh, don't, it's just above your head. You don't need to fret about this boring world. Do you know what I mean? Like that's the branding. And like, that's so unhelpful. That does not allow us to be kind of active participants in our world. And I think that it's so important that we cross that moat and engage. I should know what's going on. I should be aware of, the
To some extent, there's kind of a notion that bonds are perhaps a bit boring, a safer, less risky product. Do you believe that to be the case?
It's not magical, it doesn't like act weird. It's just it's just math. And the boring thing really super gets to me because like there are trillions of dollars invested in this world. And like, not to say that money itself is inherently interesting, but I don't know. I think it matters. Like you can, there's a if you know too much about Joe Biden eating a sandwich, like, there's a world in which you could hear me saying this and you're like, girl, you covered bonds for a decade. You're just living in boring. No, like this is, a tool to kind of exert that power and influence and control. And it enumerates kind of our morals and who we want to include and who we want to exclude, like everything you can love and hate about humanity is expressed in the bond market too, and in increasingly fun and kind of zany ways. So, to anyone who thinks that bonds are boring, like A, read my book. I'm pretty sure it's not boring. And B, Google Jeffrey Gundlach, and C, like think about like let me tell you about credit default swap, like engineered defaults. And like there's just so much to dig your teeth into because we're a creative species and we come up with a bunch of banana stuff all the time, and the consequences are enormous.
Yeah, well, it's okay because I think the majority of people listening to this podcast will share your passion.
Preaching to the choir. Yeah. Sorry, everyone. Yeah, carry on.
So one of the things we very briefly touched on there was kind of there's almost a higher barrier to entry into the bond market. Bill, in the very early days, he was just a regular Joe Blow. Mm-hmm. How did he break into the bond market? How did he get his start?
I love his like hero origin story because it's so mundane. He was just a business school graduate who graduated into a recession and there just weren't that many jobs, and he was like poking around, and his mom saw a listing in the newspaper for credit analyst at Pac Mutual, and she was like, hey, you should apply to this. And which is just like, it doesn't get better than that, right? And he actually wanted to be in stocks, ironically. And, for the first couple years of his career was like, ugh, how do I get to the stocks department? Like, this is boring. And then, the kind of opportunity opened up, the stars aligned, and the opportunity to start trading bonds, which was a revolutionary concept at the time, just started to happen. Like that opportunity began to exist, really. And Bill was at the kind of vanguard of that and helped to bring about that revolution. So he made bonds not boring, arguably. And just proved to be really, really good at it, established a really great track record, found some robust, persistent market inefficiencies that he could kind of ride forever. And the rest is history in my book.
Can you speak to that part a little more about how bonds weren't so much quote unquote traded prior to kind of that 1970s era? Like when Bill started to get involved in this market, like how did he help to, revolutionize it to some extent?
Yeah, it is kind of a really wild thought that, today to think about the bonds were not traded, but they really weren't. A company would borrow, they would, give you a little certificate that said, thanks so much for the dollars. Here's the, I promise to pay it back. And here are little coupons literally attached at the bottom of the paper that you would tear off and mail in for an interest payment. And, you'd say, okay, great. Like, thanks so much for doing business with me. You put it in the vault and you tear off those little coupons and you mail them and you get your interest payment, and that's that. And it was very stable and very, it wasn't confusing. It was just enumerated, and then that's what happened. And when Bill Gross came along, inflation was really high. And so that proposition was increasingly looking kind of bleh, right? Why would you want to accept yesterday's fixed income payment, this stream that you agreed to yesterday that suddenly, with inflation really high and rising, starts to look really like a bad deal. So Bill Gross was like, why don't I trade these bonds? Why don't I sell that bond that we bought yesterday that suddenly looks worse and buy a new bond that we like better? And, this can also apply to like changes in credit worthiness or like the outlook for a company. Maybe suddenly I don't like that company anymore and I want to sell that bond and, buy a new issue or buy, a different bond of a company that I think is going to do better. So this idea, it was present and alive in the equities market and in, other places certainly, but it just wasn't really a thing in bonds. And obviously, Bill couldn't possibly have brought about this revolution by himself, given that if you want to trade, you have to trade with someone. So there were a couple people across the country, and there's this one guy in Southern California, Howard Rakoff, who's a dear friend of Bill's, who I think of as kind of patient zero. Like, he was the guy evangelizing about bonds across the country and helped to really kind of seed the participants in this market. So, once there were people to trade with, Bill started to be able to prove that this was a good idea by putting up good numbers. And this took a while, right? Like, I think it wasn't initially right off the bat, like, wow, he made, 30% or whatever. I think the first couple years were rocky. The parent company was this very buttoned up insurance company. And they were like, he was operating as a shell company, basically, with a little model portfolio within this life insurance company, which is like not known to be a radical, like, incubator of innovation necessarily. So it was a bit of an outlier that they were able to do this. And the company kept being like, okay, like, we're going to let you keep going, but can you go ahead and make this make business sense any minute? We might have to shut you down. And so it was kind of always on the edge right there, about to not work. And eventually they proved the value of it. And they, eventually over the decades started this kind of gradual process of spinning out into their own thing.
Okay.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit, and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I'd love to spend some time talking about some of the trades. Obviously what we just discussed here is kind of the foundations for what would become PIMCO. Actually, let me just ask you before we go on to some of the trades, what was PIMCO like when it started? Obviously PIMCO's still around today, but I imagine kind of perhaps what it was in those early days is a bit different to what it's become today.
Yeah, I mean, In a number of ways. I think in the early days, they were very focused on innovation and being early to new products. And it's not so much that they don't do that anymore. I can't really speak to the like innovative side of Pimco, but that's not like what they're known for or what they put forward or, what I get when I talk to people there. I think back in the day, it was very scrappy, and they've long kind of prided themselves on, a very slim profile. Like they like to cite, assets per capita, that they just have a really, really small staff relative to the money that they manage. And that's basically been true all the time. I mean, for a while, it was like Bill Gross and Chris Dialynis and Jim Muzzy and Bill Podlick, and that was like it. And what they did was, they found a way to convince clients, first of all, to invest, to allow them to use derivatives. And this was pretty, out there when they started out. This was not what every mutual fund manager was doing at the time. And in doing so, they really gave themselves this kind of extra ability, and their fluency with and kind of comfort with derivatives ended up being a big part of their outperformance. And when I say big part, I mean it's like basis points per quarter, basis points per year, but in fixed income, like that's the way to win, right? It's not, we're not going to be talking about like 15% a year on that, but like those basis points add up. And then over time, if you have this like more reliable, there's this approach to trading that Bill Gross called structural alpha that involved kind of leaning on, it's not loopholes, but it's like the ways the contracts are built that just allow him to find extra pockets of time where everybody else is just like, okay, I have my contract, it's squared away, I'm done. And Bill's like, oh, this contract isn't going to require me to have cash for this product until the strike date, the maturity date. So I have time to invest that, money sitting around I can invest that in short dated floating corporate notes and get a little bit extra yield. And very few other people, I think, were interested in doing that. And in that way, Bill Gross was able to get those extra basis points and outperform.
I love that term, structural alpha.
I know, right?
Yeah. On that, can you speak to any examples of that? Like, I know you note in the book some of the standout trades they made, particularly kind of in those first maybe kind of 20 years or so.
Mm-hmm.
Is there any particular trade that you'd like to share that, was a clever kind of exploit, or they noticed something that was mispriced, or they uncovered an edge kind of where others hadn't looked, or in a product that others didn't understand?
Yes. So I think my favorite would be the Ginnie Mae futures, the CDRs in 1983-84. And this was a contract that was basically newish. It was invented and kind of rolled out in the late 70s. And PIMCO basically figured out that there were too many options within the contract, that there were it was like not totally, we were also kind of feeling our way through what options were and could be and how they would act. And this product just really hadn't been tested. Like rates hadn't started to fall ever for this product. You know what I mean? So there was this like sense that it had all these different levers within the contract in order to make it attractive for peers within the contract, in order to make it attractive for people to trade it. But people were trading it without really examining what those levers would mean in different environments. And PIMCO thought about it, looked at the contract, and they were like, wait, are you kidding me? Like, there's way too much here. Like, this is great. And no one else seemed to have figured it out. So, and if they had figured it out, they didn't have the word, like, they're going to rip your face off and you're not going to know it for 2 weeks. And I think that really helped kind of get their, establish that reputation for them on the street.
Yeah. What was their reputation in the industry?
I mean, back in the day, it was kind of like, who are these guys on the West Coast to some extent? I talked to a consultant who encouraged one of their very early clients. And it was definitely like, who are these young whippersnappers, like these upstarts in California of all places. And I think, which is like, been a point of pride of theirs that, PIMCO moves Wall Street west is like a thing they say about themselves. And it evolved, I think this trade was pretty early in their corporate history. So it was actually a huge deal. People kind of are like, it wasn't the biggest trade in the universe by, profit. And I think they would have gone bigger if they could have. They would have put just every single thing they could have into it. But it helped, every broker of a certain age, if you talk to a broker who was alive then and trading, they're like, oh yeah, no. Like that was a big deal. So I think before it was kind of like these, mysterious kind of whippersnappers in California that people didn't really know a lot about or paid that great of attention to. The Ginnie Mae trade helped to put them on the map. And then after that, Bill Gross started to go on Wall Street Week, the PBS show every Friday night that literally everyone in the industry watched. And that, I think, really helped him to become this kind of more mainstream finance face of the bond market.
Okay. I think I may have misread this bit wrong, but I think there was a bit in the book when I was flicking through, and it said something to the extent that traders kind of knew when they were joining PIMCO that they may find it difficult to get a job anywhere else afterwards.
Yeah.
Why was that the case? I presume this plays into the reputation still.
It does. And this is sort of an interesting, you're going to hate me. Like there's a leverage and they hate you. If you want to try to get another job, so, okay, you go do your interviews. They love you. They think you're amazing. You're so smart. Wall Street sales coverage. And they're like, hey, what do you think of this guy? And that's how you kind of know that going into the job to some extent. If you know PIMCO and you have been in kind of the flow of information and you know people who work at the banks, you may very well. And I think it can still catch people by surprise. I think it caught some people by surprise. And that kind of is you've tried to build this career, but it turns out that your years at PIMCO only serve to diminish your cumulative power, because the only power you can exert in the market is by virtue of being an agent of PIMCO. You can't take it with you.
Yeah, as you kind of very briefly touched on there, the outsized salaries were to help with that, I guess, which is another interesting point in the book. We wouldn't be doing this episode justice if we didn't talk about PIMCO's role in the financial crisis of 2008. Just to begin with there, Bill did foresee this quite well, and it seems that he kind of was a little bit too early on it. But regardless, how did PIMCO position themselves to capitalize from the financial crisis?
Yeah, they did, I think, a really good job of risk managing into it and out of it. And I think that this is what structurally sets them apart from a lot of the names. Do a big short, right? They didn't try to put on some like incredibly time sensitive options trade. They just ramped down risk and kind of sat out all these new issues coming to market that were, they try to avoid the CCC rated junk debt that's a lot riskier, that's going to do really poorly in a recession. And because, as you say, they were early, that meant that they kind of sat there and watched everyone else continuing to party for a while. And they're just like, oh, like that's painful. So everyone else is still outperforming. They're underperforming. They're just like waiting for this thing to happen. And timing the market is a really miserable exercise. And they basically had this painful period. And then finally, when the crisis did arrive, when things started to come through, BNP froze their funds and it started, they were like a little gleeful. I think Bill's notes at the time were like, you were fooled, Mr. S&P and Moody, very like, finally, it's here.
Told you.
Yeah, exactly. The moment has finally come to pass. A little bit of, I don't know if it's grave dancing. But so they were able to avoid a lot of the losses that everyone else incurred. And as a result, they had a lot more agility and ability to scoop things up when everyone else was freaking out and kind of fire sailing what they had. They were just trying to get rid of the most liquid or really anything that they could get rid of. And PIMCO was sitting there, not in pain, not freaking out, and able to buy those things up at a discount. So you see that that kind of manifest over a couple of years. You look at the PIMCO Income Fund, for example. It did great in the aftermath of the recession as well, which I think is instructive because it's not like they had one quarter of like an enormous, huge $1 billion profit. You know what I mean? It's more that it was like they structurally took advantage of the downturn, capitalized on it, and were able to kind of ride that for a while. So it's from a risk management perspective, it's like more of an informed risk. It's more of a I don't know, less scary risk and more stable.
And how did they become involved with the US government? PIMCO almost had like an influence over the US government. And I think more specifically, when it came to, was it Freddie Mac and Fannie Mae? Can you speak
Yeah.
about that controversy?
So they basically, these are the quasi-governmental institutions that backed mortgages, either directly or indirectly. And mortgages were kind of the epicenter of this crisis. Not kind of, they were very much the epicenter. And the whole crisis was oriented around, people had borrowed too much money, and we had, liar loans and, robo-signed mortgage documents. People had bought all these homes, and banks had kind of encouraged the buying and repackaged the debt into collateralized debt obligations and a lot of other structures that we know a lot more about today. But basically, the quasi governmental institutions, the kind of, they were called government sponsored, and it was sort of unclear how sponsored they were. It was not, the government had never really articulated it, and it was like sort of this halfway point that we just really didn't. He says it became acutely relevant whether or not to actually back these mortgages. So it's like you can't really go both ways anymore. You have to pick. And PIMCO made the very, very, very big bet that the government would back the mortgages, would basically say, okay, Fannie and Freddie are government institutions, like no longer questionably sponsored. They're no longer quasi-sponsored. They're no longer in this kind of. They ended up articulating it and saying, okay, we are just going to take them into conservatorship, this government institutions, and backing those mortgages. And the bottom line of that was, instead of the mortgages being in the private sector and being kind of in free fall and nobody wanting to take the loss, and these were pools of mortgages that were full of things that were defaulting. People couldn't make their payments, and the go, had the government not done that, had the government not stepped in and articulated that support, would have been just increased spiral. The situation at the time was just kind of chaos and a total zapping of trust and confidence in the system and in the ability of people to pay, and just no idea where the bottom was. And as PIMCO wrote at the time, what was needed was someone with unlimited capital, basically, with the ability to print money, with someone to step in to say, okay, don't worry, I've got this. And that ended up being, in kind of a bunch of different ways, the US government. And coming in as not just the lender of last resort, but also backing these mortgages. And the day that news came out, that was the best day on record for PIMCO's flagship total return fund. And I mean, that's no coincidence, right? Bill Gross had been an enormous investor in this space for years. The US government was well aware of PIMCO and its, kind of positioning, not saying that they were looking at its portfolio, but I think that PIMCO had been very strongly in the press and in the media talking about this and saying that the US government needed to do exactly this. So I can't speak to the mindset of, of the actors in the US government at this time as to whether or not they were, hype about doing this. If there was some reticence of, I can't believe we have to do exactly what PIMCO wants. No one told me that, but I can only imagine. So they, there was this weird thing where PIMCO was like, hey, do you mind doing this? And then the government just did it.
I actually got in my notes here, and this sort of sums it up perfectly, is I'm not sure if this was just a line you wrote in the book or if it was a quote from someone who you spoke with, but grind your view into everyone else's consciousness, get people on board, force the market to turn. I guess that kind of sums up what you just described there.
Yeah, those are my words. I wrote that.
Okay, well, let's just skip forward a bit. I know we're missing a lot of the story, but that's why you've written the book. Speak to me about when Bill's public image began to shift. You kind of described it in the book as losing his crown, but what sort of started to change the way that he was perceived by the public, and why did it matter?
Yeah, it's a great question, and there are so many potential answers. I would say the media image began to change really in February 2014. So in January 2014, Mohamed El-Erian, the CEO, leaves, and it's pretty unexpected. It hadn't been, broadcast as they normally do with, management changes, massive management changes at big corporations. And the Wall Street Journal reporters, Greg Zuckerman, who we talked about a minute ago, and Kirsten Grimes started to poke around on this. And they were like, this is not the full story, something happened. And they published this big story in February that says, turmoil at the top, and enumerates all these different instances in which Bill Gross and Mohamed El-Erian had friction. publicly in meetings, had kind of gotten at each other's throats a bit. And it kind of also ticks through a bunch of other moments where Bill Gross was kind of a jerk. And, he was hard on people in this way. He demanded that, there was no talking on the trade floor, no one make eye contact. He was just pushy in this way, intense in that way. And this was a really shocking article to a lot of people because, again, like Bill Gross was this celebrity, but his kind of day-to-day intensity and the intensity of the work culture at PIMCO wasn't known outside of those kind of credit market circles. So yeah, if you're Wall Street coverage and you talk to your person at PIMCO every day, you're going to know. But the broader retail, finance watching world wasn't aware and thought that Bill Gross was this like folksy, adorable, eccentric, like interesting guy, which he is. But there was this other side. And I think that both had the effect of like disrupting his image and also kind of got a bee in his bonnet. He had loved that image and had cultivated it for decades and had tended to it. And that was, as we just normal course of what we report on and what we see from, professional money managers or CEOs or CIOs or any of these people, So, and then I think the other big moment was the Morningstar conference in 2014, wherein he gave this like totally bizarre speech that I view in retrospect. Actually, I think, in almost immediate retrospect, I was like, oh, that was a cry for help, more or less. He was like weirdly sending up a bit of a flare and being like, things at PIMCO are not okay. Like trying to somehow, say, I'm your guy. I'm the guy, you've loved for all these decades and PIMCO's great. Everything's fine. But it was so odd and a bit jumbled and confusing. And people were just like, what's going on with this guy, actually? It's one thing to have a journal article about you being kind of mean. And it's really another to give a speech that just like wildly disorients a crowd that is like optimally primed to hear your message and love you forever. You know what I mean? So those would be the big ones that I would say, the journal and then the Morningstar conference.
And so what year did he actually wind up leaving?
2014, September.
Oh, okay. And I know this departure, even though his public image had begun to shift a little bit, his departure from PIMCO was still largely a shock.
Absolutely shocking, yeah.
What did it mean for the broader market? Did it have a larger impact?
Oh, yeah. It's one of those things that's like kind of funny in retrospect, but I cannot overstate how big this was. Like people thought that it was going to crash the market because he was just such an enormous investor at such an enormous firm. Like he himself controlled the flow of like definitely billions of dollars and like a lot of billions of dollars, like just him. So, and he had his favorite markets. Like everyone knew that like this guy likes tips. He likes Brazil. Like everyone could enumerate the things that they know that he likes and the markets that, depending on who you talk to, especially in emerging markets where PIMCO was so outsized, you can really draw a line of like, okay, what does this mean for this market? Like if this enormous buyer just evaporates, what if no one else at PIMCO has the same love for Brazil that Bill Gross did? What does that mean? Like, is there going to be so all of these thoughts, the entire market was like looking through the published holdings of PIMCO Total Return of its ETF, like just trying to figure out how they were positioned and trying to lean on those positions. And regulators were concerned. Like people expected billions and billions and billions of dollars to leave PIMCO immediately and probably follow Bill Gross to wherever he went next, which was Janus. And I think that, again, in retrospect, like that so didn't happen that it's like, it feels, there's a little bit of revisionist history that you could do where you're like, it wasn't that big. It was enormous. Like I covered it at the time and it was like just 10 alarm fire on my beat of just absolute intensity and like whack-a-mole with these enormous stories for months, just as people tried to like figure out what would happen and if this was going to be the kind of seismic shock that destabilized the market.
So was there a mass exodus of funds from PIMCO when he left?
Yes. There were massive outflows. PIMCO Total Return shrank. I don't have the numbers in front of me, but it was there had been outflows for a while, just as the taper tantrum had kind of taken a hit for bond markets in general, for especially total return style bond investing. But that and that had started in May 2013. So there was this kind of longer term trajectory, but at this point that had eased for other bond funds, and it was really just total return at PIMCO taking this enormous hit, and clients just pulling money month after month after month. And it did not follow Bill. Largely, it went to TCW, DoubleLine, and a bunch of like BlackRock, passive index funds.
Right. Yeah, that's fascinating. Just in summary, Mary, I'd like to ask you this question. Like, how did PIMCO become so massive? Like, what did they do so well and get so right?
They were early is like an easy answer to that.
Okay.
They were very much there when the lights went on. And I think that is an enormous part of their success. It's also, they were intensely interested in the details and in, I gave my little speech about how contracts express what we value and how, and, maybe PIMCO wouldn't agree with me exactly on that, but they love details. They love complexity, and they love kind of the way you can fiddle with those things and manifest your own cool trades. And I think that creativity and like embrace of products and new stuff. Every time something new comes to market, they were very fast to adopt it and very enthusiastic. And I think that was a lot of, their edge was just being not just sticking to what they had been doing, but always kind of looking for that next thing. And if there's a new world to conquer, going to it. So that's a lot of it. And I think that they were good. They were good at being, I would say, bullies. I know not everyone agrees with me on that terminology, but I think that the aggression that they demonstrated that was very unpopular on Wall Street, I think it did work. Like, I think that they did manage to establish themselves as this like very fierce and ferocious trading partner, but you did end up needing them in part because relative to the bond market, they were bigger, again, from the get-go, just having been early and having been successful early. So they were able to kind of throw their weight around, which, people I think in equity trading, stock trading talk about, agility and being nimble, and think about size as like a detractor, as something that might hinder you. And I think that doesn't really apply in bond markets where, especially in a rising bond environment, if you just buy the market, you'll do well. But also you can get the best new issue allocation. And that's extremely powerful and I think contributive to a lot of outperformance. So I think the edge changed over time.
Yeah, I really love that answer.
Oh, thank you. Good.
Last question here. What was one of the more surprising or lesser known things about Bill that you uncovered while writing the book?
That's hard because he's such an open book that so much, it depends on who, and also I'm like, what is known about Bill? Like, I know so much, and the people I talk to know so much that it's like a existentially confounding question for me. Sorry. But I think I don't know. I think his, this is weird, but maybe his humanity. Like, I think there was this degree of confusion when someone gets that powerful and successful and rich and they're legendary and they're at the top of their company and they've been there for, we forget that those people are people. And I think fame contributes to that, money contributes, all of these things feed this kind of chasm between us and them. Whoever the us is, maybe I'm thinking of a PIMCO employee, like a more junior person or just a person watching him on CNBC or whoever. I think that you're like, oh, this guy has something figured out. And the reality was that Bill is shy and introverted and insecure and, competitive to a really staggering extent and not to his, not always to his own benefit. And I think that looks, if you're standing on this side of that canyon, you're like, wow, Bill Gross, he has it all together. He's a billionaire. He's this, he's that. He's such a great trader, blah, blah. And then you also have a slight instinct to throw a stone because you think that he's this great person on a pedestal. But from Bill's experience, he doesn't want to make eye contact with these people. Who are all of these people staring at him, And yeah, he's been successful to date, but that doesn't mean he'll be successful today or tomorrow or the next day. And so this insecurity and also his kind of particular eccentricities that I think a lot of which can be attributed to or explained by his late in life diagnosis as being on the spectrum, as having as having Asperger's syndrome. Those things show like when you're trying to read that as a normal person, you're not like, oh, this, eccentric billionaire legendary founder guy is simply shy and insecure. You're reading his behavior in a really different way from what he thinks he's doing. And I think that difference accounts for a lot of the friction that he ran into in 2014. And I think, I don't know, it's just been interesting to hear from people who are like, wow, I thought this guy was a real jerk, but I read your book and I feel like I really feel for him. I thought this guy was a real jerk, but I read your book and I feel like I really feel for him. I really, I don't know, like, seems like he got a tough deal, So that's been interesting.
You online and sort of keep in touch with what you're up to. Where's the best place to go? You on Twitter or anything like that?
I am indeed on Twitter, regrettably. I am at MDC. I'm on Instagram at Marian America. And I have a Substack that I update at least annually. It's offtherun.substack.com.
Okay. And it's probably also worth mentioning that you host the NPR Planet Money podcast.
Yes, Planet Money, NPR's twice weekly economics podcast. It's really good.
Very good. Well, I will dig up all links to what you just mentioned there and pop them in the show notes.
Thank you.
Again, Mary, I really appreciate you coming on. It's been awesome to chat with you. And once again, congratulations on the book.
Thank you so much. It's been a real honor to be on here. It's been a really fun chat.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Hey, what's going on, everyone? Full-time for the past few years now. And full-time meaning actively trading the Australian market on an intraday basis. The market here opens at 10 a.m. and trades through till 4 p.m. each day. Plus, I'm at the screens doing prep from about 8 a.m. onwards, so a couple hours before the open each day. So there is at least an 8-hour chunk out of the day. Now, I've kept this quiet, so I'm fairly sure most will be unaware. I became a dad in March last year, so I now have a little boy. And of course, there goes another few hours each day. I also do CrossFit or train in the evenings pretty much every day, and I view this, being physical exercise, as a very necessary requirement for my ability to be able to trade well. So as I've demonstrated here, and as time management is not necessarily my strong point, I quickly run out of hours in the day. I basically end up squeezing the podcast in first thing in the morning or later on in the evening. And I don't know how it comes across, but behind the scenes, there is quite a lot of work that goes into producing the show. Trying to do it all on my own, there are definitely times where I feel a little burned out, which I guess shouldn't be overly surprising given I started the podcast 7 years ago. January 2015 was episode 1. And ever since, I've been pumping out episodes on a regular basis. You know, it's funny, when I actually first started, I had to explain to people what is a podcast. Now it's just common knowledge. So ultimately, this is a long-winded way of me saying it's time for me to double down on my own trading. But more importantly, what lies ahead for Chat with Traders? As I hinted earlier, the show must go on. So what does the next evolution look like? Well, from this point forward, the podcast will have 2 hosts. Yes, I'll have a co-host joining me, which I'm kind of looking forward to because it occasionally feels like I'm doing much of the same thing week in, week out, or more so operating on a fortnightly schedule as of late, but you catch my drift. So I think this is going to add like a nice new dynamic and energy to the episodes. Then, as I become less involved in time, my co-host will take the reins, also bringing in a second person, bringing more life to Chat with Traders, more interviews with trading talent. Plus, I know my co-host has a few ideas on community. Now, a stronger community aspect is something that I felt has always kind of been missing from Chat with Traders. I've often thought about doing more on this front. I often get emails asking about almost community recommendations or knowing if I know someone who lives in this kind of area or who trades in this certain way. And when I'd host live events, I know that's been a little while, and meetups too, the best part for most people was just having the opportunity to meet and connect with others who have similar aspirations. And I totally get this because when I started the podcast way back when, part of my motivation was to get to know other traders. Anyway, there'll be more on that later. So I guess the big question on everyone's mind is, who is your new co-host? Most importantly, she is a long-time listener of the podcast. Folks, I would like you to meet Tessa Dow, and she is right here with me. Tessa, how are you?
I'm doing great, Aaron. Thank you. And thank you for the warm introduction. And most importantly, congratulations on recently becoming a dad with your bundle of pure joy. I can imagine that you are in an exciting chapter in your life right now.
Yeah, I mean, it's certainly not without its lack of challenges, that's for sure, but getting through it. So Tessa, I'm not going to interview you as you are not a guest, but just putting myself in the position of a listener for a moment who wants to get a bit of an idea on what you're all about, I'm going to pretend like I don't know who you are. Would you like to share just a little bit about your trading experience? You know, are you doing this full-time, part-time? What sort of things are you trading? How long have you been at this for?
I'd just like to back up a little bit because you did mention that I've been a long-time listener, and it is true. I've listened to the Chat with Traders podcast since the early days of it. Back then, I was relatively new to trading at the time, just starting to learn more about trading. And I can totally relate to what you said about not knowing anyone when first starting out. And there weren't many people I knew around me when I started trading. So listening to the podcast for me, it felt, less lonely trying to navigate through the trading world. It not only was eye-opening, or should I say ear-opening, because I learned so much from listening to the different guests on the show who share, their unique perspectives, experience, and their expertise, and, their great trading moments as well as their challenging moments of trading. And it really helped me when I was first starting out. And so a little bit about me, I currently reside in the beautiful state of Washington in the Seattle area, but I mostly lived and grew up in Southern California. And as far as career goes, my background has been in corporate finance, not really by choice, but by circumstance. However, I must say that I'm less of a numbers person, and I gravitate towards the creative side, with ideas and strategies. I've always had that, entrepreneurial spirit. So I saw an intersection between entrepreneurs and traders. And so I started to learn to trade and started with trading equities. And then I decided that I needed to really devote my time to learn and trade. So I ended up quitting my job at the time so that I can do this thing, and thought if I had more time to devote to it, I would make the money I needed and not have to worry about anything else. And I was so fascinated with this type of trading because it involved a lot of creativity, so many kinds of strategies that you could use. And because there are just like so many different moving parts to consider in options, it just really kept me interested. But I've nearly blown up my entire account with trading options as well. And then only about a couple of years ago, I started to turn my trading around and was able to stop the bleeding and started to see
improvements in my trading. And I would attribute being able to turn my trading around due to a number of things. It's not just one thing. It's just a combination of things. Like, for example, I had, gained more experience trading and was able to learn from my mistakes and study my trades, which is actually not really fun to do because it's a process and it's not as exciting, but it's really important. So that did not work for me. There was just way too much pressure come and having it come from different sources. I just don't like take that pressure off me.
As you were talking there, one of the things you said was there's a lot of different things you can do with options, like so many different strategies. Can you just briefly share maybe the sorts of things you...
Sure. I mean, in the beginning, when I was learning options, I learned to do more simple type of setups, like directional. Is more directional in the beginning, setting up just with a couple of legs, like a call option or a put option, a long call or a long put, just really basic. And then over time, I learned how to add more to that. So you can, as you learn more about the different strategies, you can start adding more to the basic. Yeah, it sounds complicated, but my strategy was to be more neutral in the direction. And I like to trade options around earnings, right before earnings, during earnings, and I'd be happy to share more about that in detail at some point. But basically, that is kind of my strategy, is to trade around earnings.
Excellent. When's the next earnings season?
It's happening right now. And usually, as I mentioned, I don't trade full time. My options trading strategy is such that it requires about 10 hours, about 2 months out of every quarter.
Okay. So earlier I laid out a few reasons for my motivation of bringing on a co-host. Let me ask you, what are some of your motivations for being a co-host?
Yeah, well, aside from the fact that it's really cool to be able to co-host alongside you, Aaron, co-hosting is also a way for me to contribute to the trading community in some way. Because I feel like I'm also on similar journeys as many of the listeners out there. I understand the journey that the traders go through, and I want to be able to help advocate, especially for knowledge and support, to be able to develop into that. This has helped many traders on this show the last 7 years since this podcast was born, and I want to share that I am so happy to share a little bit more about is helping to build the podcast's very own community. Will be embedded in the chat with traders to deepen and bring more meaning to their trading journey by connecting and learning and supporting and holding one another accountable. Something that's and smash those discouraging statistics on trading and instead make progress, no matter how small, towards becoming better.
Just for myself and for Tessa, a little bit of podcasting experience, but it is should be coming out next week. And a trader who goes by the name of Nicholas. And this episode, some of you may recall, probably about the mining industry. And he came into trading through the avenues of Wall Street bets and signal providers and that kind of thing. Played out more often than not. But he's come out the other side and numbers, but definitely on the right track and just very...
Convert large caps over small caps.
Interesting as small caps over the large caps, but he's found his edge playing in the bigger stocks. So that's really cool. Just something a bit different. Next episode.
Thank you, Aaron. And I'm really happy to be here and appreciate you for having me on the show.
Chat with Traders is brought apps made trading seamless and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time funds home-based stock traders with up to $200,000 in buy. That means you can trade larger positions and scale your strategy
With the trials and tribulations of full-time trading. A little while back, I did several episodes following this same theme. They were quite popular and relatable to many. I guess it's a slight... So, Nick, I don't recall exactly what year it was when you started experimenting as a trader, but just tell me before.
And at the time, I was making wood-fired pizza. This March, moved down to the mountains of Virginia. Sold my house in Iowa and moved 1,200 miles away.
And tell me, how did you actually discover trading? When did it first come onto your radar?
I've been browsing Reddit since since it was a new platform, and probably around the time Wall Street Bets started picking up and hitting the front page, and it was around the time that the marijuana stock boom happened. And I remember seeing people posting their screenshots from their Robinhood app of making 1,200%, 1,500% off of just oh, I want to do that. And of course, that didn't go very well.
Okay. Yeah, this is what's interesting about your story, is because that was your entry into trading, was through Wall Street Bets and kind of
Tilray and CGC and all the marijuana stocks that were just shooting up like crazy, with the potential of I think maybe they legalized of money book or nature whatsoever.
Right. So tell me about when you did actually commit to putting on a few options trades, getting your feet wet. Where did you begin to sort of commit some money to this?
I think Tilray was my first trade. And I bought it when it IPO'd at $17 and maybe just 8 or 9 shares. I mean, I might have put $100 or $200 into a Robinhood account in a time of my life where I had probably $3,000 in credit card debt, and I was mostly paycheck to paycheck. Not struggling paycheck to paycheck, but I wasn't building up a bank account by any means at the time. I was paying off bills. I'd recently paid off a car, recently paid off student loans. And then so it was kind of attractive to me. It's hey, I can maybe make some money in this as well. I was working evenings. I always had mornings off. So it was possible for me to watch the market, which at the time was on my phone from Robinhood. And then I think I sold Tilray. Parabolic moved to 300. And I'm oh, well, how do I get on this?
Yeah, I remember that. I don't trade the US market, but
it opened, I think, around 150, ran to 300 on the dot, and then just plummeted right back down to in the hundreds.
Yeah.
And that was the first time I'd seen a short squeeze or even knew what that was, and I was wow, this is wild.
Is that what sort of fueled that move? Was it a big short squeeze?
I don't know, because at $300 and it's going to keep going when it was 150 an hour ago, but maybe that's also why I'm still around and most people on Wall Street Bets are posting losses.
So tell me a little bit about the timeline. How long did this kind of go on for? I think just from our previous chat with you, I think there was a point where you kind of trade over the next kind of few months.
I just really okay, I'll put 100 more in there, and then it was I don't know what I'm doing. And so I ended up putting it down and just kind of be okay, or swim, and signed up with TD Ameritrade and started actually instead of just line charts, and really just kind of dug into it. Winters in the American Midwest are terrible, so you find things to do inside to keep you busy from going crazy. And for me, working in the evening.
Did you learn it through classes? How did it come to you?
A class that was a video composition, your basic, what is a candlestick, what causes it to move, And then around February of 2020, I joined one of this right now. I'm selling this right now, but he really emphasized his trading method and this is how I trade big tech, and give like conference calls on the weekend to explain like his views of the market and like if this happens, this could happen. Puzzle games, and that's kind of what the market was to me. It was this giant, always moving puzzle that if you can find the right pieces, you can bend it in your benefit.
And did you just go in and trade it live, or did you start out with paper trading before you did that?
Just went straight into it. I actually didn't know what paper trading was until after I was probably knee deep into it. And then I was like, well, there's no reason to go back now. I do paper trades sometimes where I just like to go back on like my trade ideas for the week and see how they did. I'm not paper trading on an account, but I think it's really beneficial to always keep track of any idea you have.
You mentioned you were kind of risk averse, and to not really do the paper trading for a while first before going live is just really impressive, I think, because it just shows like how brave you are to just go straight in.
Trading contracts or $800 Tesla contracts. Like I was looking for like the old ETF and then trying to get my feet wet with cheaper things. And then sometimes if something went like even a few dollars against me, I would cut it. First 3 months of 2020, it's like my average $18 and my average win was like 20 or 30. Going into the market, like going ham for money. I was like, I'm going to like learn this and then work my way up.
Nick, just for some clarification there, when you spoke about, you did some classes there, you also mentioned that there was, okay, so the signals obviously wasn't, well, I presume it wasn't a great success for you.
It actually was in my own way. I realized pretty quickly after I got Thinkorswim, I like learned that you can pull up charts for individual options contracts, and that's something I got really into. I was like always studying like how do the options move next to the stock, because I realized early on was when this guy was sending a signal, there could be 4,000 or 5,000 contracts trading in like the next minute or 2 minutes from everyone piling in. And that alone, if it was like or even AMD at the time wasn't a big name, his signal could have moved the like the option contract 20 or 30% in those couple minutes. And so I turned it into a game of that initial volatility push.
Okay, there's nothing wrong with that. That's kind of clever.
Which I didn't even realize at the time what I was. My demand's off balance, but then I was like, why am I just going to sit here and just like, maybe this works, maybe it doesn't, when I can take 20 or 30% every time he sends one of these?
Right. Well, I know you obviously don't play that game these days. So, you did move on from that. Talk to us a little bit about how you began to develop your own trading approach. Like you kind of went down this route, you've sort of gone through and you'd done like a bit of a class or some sort of education there. You'd done a few different things, right?
Mm-hmm.
You'd run out of money at some point. You'd come back. At some point, you start to you.
Right, but it is also, there's a million ways to do this, and it's fascinating. And even like today, my approach has to be changing because we're not in a bull run where things just run straight up anymore.
Can you speak to that part about actually sort of starting to find your groove? Like, what was that like, and to build that into, or sort of blend that into your own approach, is when sort of things can start to take off?
Options like that through 2020, but also trying to do my own ideas on the side. And like through 2020, my account was probably never more than $3,000 or $4,000 because I was just continuous trading. But a similar style of focusing on big tech, or at the time, like all of the high PE ratio, like Square and Zoom and Shopify and just all those high flying names, just mostly like scalping breakout style. I think like late last year is when that really started fizzling out. And then I really like trading like psychological levels, like 100, 150, 200, 250. There's usually like I kept it at through 2020.
How could you maybe share any challenges that you faced with having a small account, or maybe it wasn't a challenge for you? Would love to hear about that.
With options, it really wasn't 1 or 3 contracts at a time max. I've never hit like that 15 or 20. That's just like way too risky to me. I was looking to like keep my risk probably between $100 to $200 per trade if I even drew down that much. And a lot of these bonds
And how
on the March lows, but also I had no concept of risk management at the time or system in place. And I was just like, take this trade, take this trade, take this trade.
Yeah, and would love to talk about risk management pretty soon and about that. And so in 2020, you were doing that full time?
I worked pretty much like I went to work at the equivalent of 3 p.m. Eastern. So I was available for the multiple hours the market is open. And so I was able to be there for that every day.
Some time during the day to, monitor the market and
apps, then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to platform? You don't need millions or even thousands to start trading the US stock market. Even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with a profitable offers of free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's Capital.
as we're talking about 2020, when we were talking via email, that you a little bit. Obviously, we know what happened in 2020.
Right. And it's like around that January, February is when I got interested in trading again. And then March was like chaos, everything's shutting down, restaurants are shutting down. And so for me, it's like the restaurant industry is all I've ever worked in. And I mean, everyone is panicking. Like, where are you going to make money if all the retail locations are closing and all the restaurants are closing, all the offices are closing? So for me, it was like, okay, I need to make this work for me as a just in case.
Let's move along here and talk about the actual point where you decided to go full time. So I don't know if you did.
It's too, because I was still working in the evenings, but was making a lot more money because of just how much higher our sales were. And it was just like me and a bartender doing to-go orders and splitting the tips for it. So I was also able to like build up like a little bit of a cash cushion from that.
Yeah, that's funny because I mean, so many things just happened during that time which no one could foresee. It was like the opposite, oblivious to what was going on in the rest of the world.
Right. And it was just also like a lot of people like me who got the stimulus checks and was like, hey, let's throw this in the market.
Yeah, of course. There was plenty of that. So at what point income for you outside of the market, and we'll get to that, but
probably around last fall. And just kind of like wasn't digging living there. And so it was kind of a mix of me like wanting to move away, but adding for 2022 to like kind of want to like go for this.
What month is fall? Like what time of the year is that? I don't know what 2021 that was.
Gotcha. Probably around September or October.
Okay, so it's been about 9 months roughly?
About 9 months since I was like, I mean, I didn't quit my job until this past January, and then we moved in March 1st is when we moved.
Okay.
So since March is what I would call my full-time approach.
Okay. What I'm trying to build up to here is basically just asking you, like, what gave you the confidence to go full?
My house was a big cash cushion. I made like a 60% profit on that. And just kind of like looking back, like last year I started really taking like the time to track all my trades, looking at statistics, and it's like, even if I don't make money month to month or day to day, it's like over the long run, it's like you're making money consistently. It's like, and I work well under pressure for the most part. So I was like, I was just like, all right, I'm going for it. Like I went 2 years with having 2 down months that were pretty insignificant, and then just building up like a really good profit cushion to kind of lean back on.
Did you make enough money to cover your living expenses?
Oh yeah, I'm like good for like I said, I'm very risk averse. Like if I ended up in a situation where even if it seems like 6 months out or a year out, I run out of money, I would like instantly like cut my
Sharing. Just a bit of a guide, if you don't want to give the exact number. How much savings? I know this is sort of a bit of a personal question, but for people who are sort of, it's such a big leap for some people to take the point from being employed, having the safety of a paycheck, and jumping to full-time trading, which is quite a risky. Which kind?
After my house closed near the end of March, I was around 50,000 in my bank account. Approached it in a way where it's like I don't have any debt, I don't have a car payment. A way where it's like I don't have any debt, I don't have a car payment, and my monthly expenses are maybe 12 to 1300 a month. Like I live very frugally.
Did you have a plan B or like sort of a cutoff point where you said, you know, if I don't succeed at trading over the next kind of...
Sure. I mean, like in my head, it's like if I drop to, I'm a little bit more sensible about it, luckily.
You started a startup, a pizza startup, I believe.
People, and it's kind of for fun. Like the great thing about like restaurants are a terrible business if you want to make money. It's just like nickels and dimes on the dollar for so many hours and amount of I really do enjoy it. That's why I've done it forever instead of seeking something that was higher pay. A couple weddings on the weekends.
The reason why I asked that too is because this is what I'm curious about. If you were to have a choice between trading full time versus having your pizza business full time, and they choose.
Oh, I would trade, no doubt.
Really?
I would sell the pizza concept to somebody and trade full time.
Okay. That one, so I know how it feels like to run a restaurant, like basically no life at all.
It is, and it's
you're
like
working
when you do
every
it for
single
so
day.
many years, it really like piles on you. You never have nights off. You're there every weekend, and it's just kind of like it is fun.
Yeah.
So Nick, I'd like to ask you, once you did go full time here, were there any unexpected challenges that you had, you know, which you didn't anticipate beforehand?
There was. So like I mentioned earlier, in 2020, I started at 10,000 and I ended up doubling that. And then after my house sold in this past March, I bumped myself up to 40,000 and I was like, okay, I've got some backing. I can make some real money, and down to 0.5%. And I'm doing much better.
Do you think you just sort of jumped in your risk per trade kind of thing too quickly?
I do. I think just trying to go from that 1 to 200 to doubling it to 400, and also going back to like my scalping habits and just kind of not coming from much money. It was just like, it's really hard to watch that go by still.
Okay. So what did you do? I think this is kind of an interesting point that you bring up.
Risk in half, but I also broke up with options and have been more focused on equity trading now that I have a margin account and I'm able to. And that has helped me immensely with being able to hold positions longer. I'm trying to focus more on bigger pick that. And so it's like I'm trying to learn a different game at the same time as cutting my risk. But moving from options to equity, it's also kind of like, oh, I've been playing this game on like the hardest mode for 4 years now. Like it's definitely, it's not easy, like, oh, this is easy to make money, but compared to like trading options where if something moves up and comes back to your stop and you're down 20% because the option expires this week, it's just really frustrating to like watch the volatility in those compared to equity.
Right.
Did you learn any other strategies with options, or were you just scalping?
I mean, mostly I was focused on like just the momentum 2020 where stuff like Zoom could easily pop $4 or $5 at the open, and Tesla doing its ridiculous run. Like it was very frustrating. So the days that they would take off, I would completely miss it. And so that was also a part of me trying to switch over to equity now as well, where I can't come back to break even and the option would be down 20%. I was like, whatever, I'm just going to take the scalp and go with it.
Yeah, I hear you. I mean, the hardest thing for me, like I trade options now. It's kind of the opposite. I used to trade equities, and now it's interesting to hear that you had started with options, and now you're trading equities. More success with this type of trading, and maybe if you can share a little bit more.
And what I like about trading stocks, it's much easier for me to manage what my risk is. And so on the side of my screen, I have a table that I update every day with what my account value is. And it's a chart of like where my stop is, whether my stop is. And it's a chart of like where my stop is, whether my stop is 25 cents or 40 cents or risk. And in this market, it's hard. Like when Lance did his interview days, and so like right now, you don't want to be the person that's trying to buy breakouts, but you also don't want to be the person that's trying to short when and shorting into psychological levels. Like Roku has offered multiple short opportunities at 100. In-phase energy, the backside of its stock split, when it ran like, I think you're by Amazon for $2,000 a share, we're buying it up with the plan of unloading it onto all the people who are going to be excited about $100 a share Amazon. And it ended up peaking, I think, around 128 and some change that day. I shorted it at 128. I got out at like, I think 121 or 122, but it ended up dropping all the way to like $102 over the next few days.
Okay. Nick, I'd like to flesh this out a bit more and kind of, really just break it down. Starting from scratch, like what are the sort of things you mentioned there? Can you just go into that a little more? Like, how do you define what's strength? How do you sort of pick your points for where you want to short? Like, what are sort of some of the key things?
Just like large multi-day run up into the split. And so when it's up 27% that quickly, like it's more probable that to short it at that psychological level than expecting it to break out in the current conditions. I really like the even number trades like 100, 150, 200. Those tend to have merit where if you've long and you like bought the dip or if you're short, like kind of like the opposite scenario.
Okay. And can you timing your trades? Like you are an intraday trader, right? So you're not really looking to is pretty key. Like I know you're looking for these like round number sort of reversals around these round numbers, but what about timing it? Like you're looking for sort of an overshoot of that, a bit more about the timing.
The last trade I took on it, like I put a stop in at 102. That was like the previous day. Otherwise, today just looking for something to kind of get like what Lance calls the right side, the names that were going to have high volume in the options. That way they had smaller spreads. So like Apple
Trade setups.
I have one screen that is always SPX, Triple Q, Arc K, and the Dow. And then I kind of look and see what they're doing pre-market and what their last few days have looked like, who's weaker, who's leading. And then I might break it down into like the sector specific, like the XLE and XLK for tech, and just kind of start growing through and be like, okay, this is stronger. What's leading it? This is weak. Why is it weak? Who has earnings coming up? And mostly just kind of based like starting on the large scale of the ETFs and the like SPX, and then kind of going down from there.
Mm-hmm.
Nick, one of the things which I found particularly interesting from your trading performance is the smoothness of your equity curve. So I'd just like to ask you, like, how have you been able to achieve this with such minimal drawdowns? I think you said that you had only 2 red months in 2 years. Now, I know you've already highlighted the fact that you're fairly risk adverse, but I don't know that that necessarily is the answer here, because, you know, just because you're risk adverse doesn't mean that you make money. That could still be an equity curve with some just some slow, drawn out drawdowns. What do you think has been kind of the key for you to being able to keep your equity curve up and to the right?
Oh man, I ask myself that question sometimes too. I don't know. I guess it's just like I said, like when I was trading options, like if something started to go against me, I would usually cut it right away and then just like kind of move on.
Okay.
And it's just like that kind of the cliche statement of keep your losses small and your wins large. And I know that's been echoed so many times, and that like a lot of people can be like, well, yeah, like that makes sense. But for some people, that's really hard to do. And I'm never like married to a trade. Even as soon as I get into something, I'm like, this is probably going to lose. And so I think having that attitude has really helped me out, because I've never been so sure of a trade that I'm going to hold on to it. Like I just get out if it doesn't feel right.
Okay. Do you know your win rate off the top of your head?